Mastering S.I.Ps. Welcome to the definitive guide on mastering systematic investment plans, your most systematic path to achieving true financial freedom. The dream we all share, the dream of financial independence, a life where money works for us, funding everything from travel and education to early retirement. The problem, but the journey can be daunting. The stock market is famously volatile, and the fear of timing the entry often paralyzes new investors. The solution, fortunately, there is a powerful and proven solution that bypasses this risk entirely. Enter the S.I.P, the Systematic Investment Plan. What is a S.I.P? A S.I.P is not a product, it is a disciplined process. It's a method of investing a fixed, small sum of money regularly into a mutual fund scheme. The autopilot savings. Think of your S.I.P as the autopilot for your savings. You set the destination once, and it consistently builds your wealth in the background. Discipline in the world of investing, discipline often triumphs over intelligence. S.I.Ps enforce the consistency you need to ignore market fluctuations and win the long game. Rupee cost averaging. Intro. The S.I.P's foundational mechanism is its secret weapon, rupee cost averaging. Scenario A. Markets fall. Here is how it works. When the market price, or NAV, is low, your fixed S.I.P amount automatically buys more units of the fund. Scenario B. Markets rise. Conversely, when the market price is high, your S.I.P automatically buys fewer units. The net result. The net result is powerful. You effortlessly buy low and high, ensuring your average cost per unit remains low over the long term. Visual summary of averaging. Rupee cost averaging smooths out the market's bumpy ride, turning what looks like volatility into a consistent advantage for the investor. Compounding. Intro. If averaging is the key to entry, then compounding is truly the eighth wonder of the financial world. Snowball effect. Compounding is the snowball effect. Your returns are reinvested to earn even more returns, turning a small beginning into an avalanche of wealth. Plant growth. Visual growth takes time. In the early years, it may seem slow, but trust the process. As the corpus grows, the interest earned accelerates exponentially. Linear versus exponential. The power of compounding is clearly seen here. The gap between your invested capital, linear, and your market value, exponential, widens drastically over decades. Start early. Stay long. Time is your most critical investment component. Starting early is far more important than the amount you start with. How to start? Ready to put your wealth creation on autopilot. Starting a S.I.P is simpler than ordering a pizza. Step 1. Select the platform first. Choose a reputable asset management company or a trusted investment platform with robust digital support. Step 2. Complete KYC. Next, complete your one-time digital KYC process, providing standard documentation like PAN and Aadhaar. Step 3. Choose your scheme based on your financial goals and risk appetite. Select the mutual fund scheme, equity, debt, or hybrid that's right for you. Step 4. Set the mandate. Finally, set the mandate. Link your bank account and automate the fixed deduction to secure your financial discipline. Ease of use. Once the mandate is set, step back and relax. Your financial future is now on autopilot. Which fund is best? The question isn't which fund is universally the best, but which fund is the best fit for you and your goals. Equity funds. If your goal is long-term wealth creation, 5 years or more, choose equity funds for their high growth potential. Debt funds for short-term goals or capital preservation. Debt funds offer stable, lower risk returns, Ideal for maintaining liquidity. Hybrid funds offer a balanced approach, blending the growth of equity with the safety net of debt instruments. Selection metric number 1. Track record. When evaluating funds, look for managers with a consistent track record of outperformance across diverse market cycles over 10 years. Selection metric number 2. Expense ratio. The expense ratio is the fee you pay. Always aim for a lower ratio, and preferably choose a direct plan to maximize your net returns. Selection metric number 3. Risk profile. Beyond returns, evaluate risk-adjusted metrics like the Sharpe ratio to ensure the fund delivers adequate returns for the level of risk it takes. Myth: I'll wait for the dip. Do not fall for the myth of timing the market. Waiting for the perfect dip often means missing out on significant long-term growth. Truth: time in. Remember this golden rule: time in the market always beats attempting to time the market. Comparison table. The S.I.P is stress-free, spreads risk, and requires zero timing, making it the superior choice for most regular investors compared to a concentrated lump sum. Flexibility. S.I.Ps are incredibly flexible. You can start with as little as 500 rupees, pause your payments if needed, and use the Step Up feature as your salary grows. Conclusion quote: as the great financial philosopher Jim Rohn reminds us, discipline is the bridge between goals and accomplishment. Your S.I.P is that bridge. Final summary. To summarize your S.I.P wealth journey: start early, automate your investments, ignore the market noise, and simply stay invested for the long haul. Questions. Thank you for joining us on this guide to mastering S.I.Ps. We are now happy to address any questions you may have about your financial future.